Hi, my name's Marc Chapman, manager of the Principia European Equity Fund. Looking at the month of June, the fund appreciated by 2% over the course of the period in the context of an improving European equity environment. Over the past few months, there's been significant discussion about whether a recession will occur in Europe and US in the next 2 years. Now, the central banks around the world are very cognizant of the fact that there's a lot of financial leverage in the system. This takes the form of either US student loans or debt at financial level or government debt at the European level. Because of that, the system is more fragile, and if a downturn did occur, the effects would be more negative. However, we think that proactive action will remove that risk for the time being. There has been a long period of expansion in terms of economic growth, but just like the toss of a coin, after 10 tosses of heads, the probability of a head or a tail is still 50-50. So the long period of expansion does not necessarily indicate a likely downturn. Looking at the fund, the majority of performance last month was stock specific. In particular, Altran Technologies got taken over by another French company, Capgemini. Altran is a holding that we've had for the past 2 years. In 2018, there were specific issues with the company regarding an acquisition they made in the US and the integration of this business. That created some disturbance to their market profile and caused a devaluation in the market cap. Following these instances, we reviewed the case and decided that the underlying organic growth would remain solid and the free cash flow yield was attractive at the end of 2018. We held the position during this year and it was acquired recently. In terms of looking at the European universe, recently there's been a dichotomy in terms of performance. Structural growth companies are re-rated to multiples which had never been seen before, while value cyclical names continue to underperform. And while we don't look at these general trends for ideas, we do look more stock specifically. We would say that there is now some good value in cyclical names where expectations have now corrected a reasonable amount and where the free cash flow yield is attractive in the context of a world where the bond market yields hardly anything. One such example would be Andritz in Austria, which makes capital goods for the pulp and paper and automotive industry. Following a period of disappointing operational delivery, the company now has a free cash flow yield above 10% on 2020 earnings. We consider this very attractive. We have other such examples in our long book, and in general, we've been finding more ideas in areas such as technology, automotive, and other cyclical elements, rather than defensive marketplaces, which are already quite highly rated. Overall, the exposure in terms of long book is about 75%, and the net exposure is plus 10%. The risk resides at the stock level, and we see 35% upside over 2 years to our long book. Thank you.